All right. Thanks for tuning in to another episode of Retire Right. I'm Ryan Wyatt. Per usual, I'm joined by another one of our wealth advisors here at the firm, Nick Lewandowski. Thank you for joining, Nick. And Nick is also on the investment committee here. He's co-chair on the investment committee at Wyze Wealth Advisors. The topic that we're going to discuss today is the new law that was passed by President Trump on July 4th of this year. That is the One Big Beautiful Act, the One Big Beautiful Bill Act, OBBA for short. Now, there are a lot of changes, and this just happened not too long ago. We've spent a lot of time scouring through all of the changes. What we're going to do is we're going to keep the podcast episode very high level, really just in an attempt to keep the episode at a reasonable length. The blog post that accompanies this episode is going to have a lot more detail in terms of specific numbers and dates in it. So we really do recommend that that you read that blog post. And again, that'll be posted on our website when this episode is live. What we're going to do is we're just going to focus on what's changing, its impact, any planning opportunities that are available based on these changes. Something that we just really want to emphasize is that when we talk about some of the changes and you're thinking about your situation, you might think that these changes require you to start going down a different path or really require you to take immediate action. And ultimately, that's something that we're reviewing on a case-by-case basis. Not all of these changes are going to apply to your situation or require you to deviate from the current plan that's in place. Of course, we are going to be reviewing that. If you have any questions, in the email that included this episode, there's a link to schedule a check-in meeting on our calendar, on your advisor's calendar. Please do not hesitate to use that. We are happy to answer your questions and just revisit, hey, do any of these changes apply to you and your situation, and again, require you to take action or maybe speed up some of the goals that we've been talking about in the past and think about implementing those sooner. So with that said, let's start talking about some of the changes that are going to be taking place. And Nick, I'll pass it over to you. Can you talk about what's happening to the standard deduction?
So standard deduction, and some of this will apply to the brackets as well, but the brackets that we use currently and the standard deductions we use currently were set in the 2017 TCJA legislation. And those rules were set to expire at the end of this year. So that's why it was really important, if they were going to make a change, to do the change in 2025. So as far as standard deduction is concerned, the amounts that we have been using since the 2017 law passed are now permanently extended. And they're going to see an increase starting this year, and they're going to be adjusted for inflation annually as well. So this is just going to continue the trend that we've seen since 2017 of more and more taxpayers, because of the large standard deductions, are not going to need to itemize. It's not going to make sense for them to itemize. And so it places renewed emphasis planning-wise on the deductions that you're allowed to take directly to your adjusted gross income that you don't have to itemize for. Pretty straightforward there, and that's just a benefit to most taxpayers. Small reduction in taxes there for most people. On the bracket side, Ryan, over to you.
So what's going to be happening to the tax brackets is the existing brackets. So you think like 10% tax bracket, 12, the 22, 24, those are being made permanent. And there's actually a minor adjustment being made to the two lowest brackets. Now there will be some inflation adjustments that are going to kick in starting in 2026 to the tax brackets, but really the thing that how this would impact people is that they can expect a modest reduction in their effective tax rate, which is essentially the average rate that all of their income is taxed at, because the two lowest brackets are expanding slightly and more income will now be taxed at those those lower brackets. One of the other things that we wanted to cover was what's happening to Social Security and how it's going to be taxed. There was some speculation that the tax structure for Social Security benefits was going to change, and what we can do is confirm that nothing is changing. So the current tax structure for Social Security benefits is staying the same. We just wanted people to be aware of that.
All is not lost.
Yeah.
There is a little like salt in the wound there, but we'll cover that in a little bit.
And I'm not sure if you did that on purpose or not, but speaking of salt,
oh, I didn't actually. That's funny.
I want to transition to some more, focusing on targeted deductions and tax credits. Some of the changes that are happening in this area, and what we did was we broke it down into 3 categories because each of these changes is going to apply to different people depending on how they file their taxes. So the first category is for people that itemize their deductions solely, meaning their itemized deductions actually are greater than the standard deduction, and so that's why they are itemizing. The next group is for people that are only taking the standard deduction, and then the third category is for anyone meaning people that itemize their deductions or take the standard deduction. So Nick, why don't you focus on what is happening to the changes for people that itemize their tax deductions?
Yeah. So let's get back to the SALT thing. State and local tax deduction, we often refer to it by the acronym of SALT. And this is a huge deal for people who live in high tax states and localities. So think your Los Angeles, Californias, and your New York cities of the world in particular. But it's a deduction that allows them to deduct from their federal taxes what they paid in state, local income, sales, property taxes. And if you live in a high tax jurisdiction locally, that can be a really big deal to you. This has been a bit of a political football in recent years. And to get this bill passed, they had to raise the limit from what it was previously. So previously, this was capped at $10,000, which didn't do people in LA and New York a whole lot of favors. It's temporarily been increased to a significant level. I think, don't quote me on it, it'll be in the PDF for sure. I think it's like 40,000 or something like that. That now, if I'm remembering the number, okay, you said that's correct. So it's expanded for a few years, and then it will automatically revert if they don't do anything else about it. So we'll see what happens. And then for certain high income households, there's also an income based reduction that happens as well.
And that'll be included.
That'll be in the other blog post as well. So it's pretty straightforward. Like either you benefit from the deduction or you don't. Right. If you're in a really high tax state, it's kind of a freebie almost in that you'll probably be able to deduct more. The other big area of itemized deductions that there's a new rule for is related to charitable. And this is specifically, again, charitable that you would take as an itemized deduction. There is a floor, meaning a minimum amount you have to actually donate to charity before it starts counting toward that deduction. It's not a very high floor. It's only about 0.5% of your adjusted gross income. But it cuts out, like if you do $500 or $1,000 of charity and you make a good amount of money, you probably won't exceed the AGI floor to have that count toward your itemized deductions, depending on your income. So it takes those small deductions off the table is what it does. For folks who are very philanthropic, doesn't make that much of a difference in terms of the floor. So it just is really, if you think you might be on the bubble of itemizing, this is really one of those things where it becomes a timing thing from a planning perspective to maximize your tax benefit. Right.
Now what I'll do is I'll transition to the changes that are relevant for people that are taking the standard deduction. So first thing worth mentioning is the charitable deduction, again, for non-itemizers. So what's changing? Charitable deductions permanently restored for taxpayers who, again, take that standard deduction. So starting next year, what you can do is deduct cash contributions up to a certain limit. And this is a charitable contribution that is not subject to the new AGI floor. So that's really important to mention. what this really ends up doing is just providing a tax incentive for, say somebody's maybe middle income, maybe their income is, they're retired and now they are getting income replaced from their portfolio. They're no longer working or in a joint household where there's two incomes. This is a incentive for maybe that group of people to make charitable donations, not have to itemize, but still receive a tax benefit. And then transitioning into the changes that really apply for anybody. So again, if you're itemizing or just taking the standard deduction, first thing is auto loan interest. There's an auto loan interest deduction that is now available. Now, there are some nuances with this that are worth mentioning. So one, it's temporary, and we will have the dates in the blog post. And two, there are limitations, income limitations. And three, it applies to U.S. assembled cars, vans, SUVs, pickup trucks, etc. What this ends up doing is it could influence the decision for making a purchase sooner rather than later, because again, there is a temporary window to receive this tax benefit. So it could just end up speeding up that timeline for purchasing an eligible vehicle and receiving a tax benefit. And then, Nick, can you cover the last change that applies for anybody that's taken the standard deduction or itemizing?
Yes, and this is the consolation prize about the Social Security thing. So Social Security is still taxable, like Ryan explained before. The thing that they did build into this law to help deliver on that promise with Social Security is for seniors age 65 plus, there's an additional standard deduction amount. Essentially, it's kind of more like an additional allowance, but 6 one way, 1/2 dozen the other, that they're able to take, which it doesn't count specifically against Social Security. It's just all income, but it is a little bit of a break for folks who are in that kind of like Social Security Medicare zone.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
The third and final area that we want to focus on is what future planning considerations are worth being aware of or thinking of as a result of this law that was passed. So, Nick, can you talk about the child tax credit, please?
Child tax credit is pretty much one of those things that just is just more beneficial to people now. So it was increased temporarily under the 2017 law, that law that we talked about before. It's now been permanently increased to those levels starting in 2025. But the even bigger deal in some ways is that now it's also subject to an inflation adjustment every year. So now the child tax credit amounts will go up by an inflation adjustment starting in 2026. They didn't do that before. So that's a nice benefit to folks with qualifying children. The inflation benefit is really nice. Sure. as well. What doesn't increase with inflation is there's income limitations. They're pretty high. So a lot of families don't run into these, but if you're a very high income household, your income limitation for child tax credit did not go up. It's not indexed to inflation.
And that is important to mention, that the credit amount is indexed for inflation, but the income amounts, which again will be in the blog post, are not.
No. This next one applies to not that many people, but the people that it does apply to, it is a huge deal, and it's the estate tax exemption. So if this law weren't passed, the estate tax exemption, federal estate tax exemption, was set to automatically reset to a much lower level. And this was going to be a huge problem for a lot of people with large estates. It was really going to have to cause a ton of people to have to revisit their estate planning if the amount reset lower. Happily, for the affected individuals, the exclusion amount was actually increased somewhat from where it was before. So it's now $15 million per spouse if you're married filing jointly. The short version of this is if you and your spouse, by the time the second one of you dies, if you are going to have less than $30 million of assets in your estate in today's dollars, not going to have to worry about federal estate
Right.
tax. So, that's a very nice benefit, and that exclusion is indexed to inflation as well. So it will go up over time. Again, not that many households are subject to it, but those that are, those rules are a big deal.
Yeah, and we'll, of course, we just did some rounding there. The exact amount for spouses, the combined, total exemption amount will be included in the blog post. But again, what you're doing is you're taking each spouse's exemption amount, which is $15 million and change, and combining the two of them. And if your estate is less than that value, you don't have an estate issue, meaning you don't have to worry about estate tax. Mm-hmm. Nick, can you talk about the changes for 529 and the eligible expenses?
Yeah. One of the things we've seen over time with 529 plans is, I think, just in recognition of how education continues to evolve and the cost associated with it, is 529 plans have become a lot more flexible in terms of the qualifying expenses where money can come out tax-free. So now you can use 529 money for even more K through 12 expenses, even before college. Curriculum materials, textbooks, online education, tutoring, standardized test fees. There's a lot of stuff. Educational therapy, and there's a limit that applies to those, which will be in the blog post. But that limit increases as well, starting in 2026. Post-secondary credential expenses is new. This is a really cool provision. So post-secondary credential, what is that? In our field, this is actually super applicable because things like the CFP designation, CFA designation, CPA designation would fall into this category. These are like not things you go to graduate school for, but they're things that you study for. There's fees, there's materials, there's tests you have to take, and 529 plans will be able to be used for these kinds of things. So you budding financial planners in the audience, your 529 can help fund your trajectory in our profession now. Again, this just boils down to more flexibility. It helps people not have as much money potentially trapped in 529 plans. It gives 529 plans more utility for people who aren't necessarily just pursuing a straight up, I'm going to go to a 4-year college and then go get a master's degree. There's just more stuff you can use the 529 account money for.
And one of the other, I think it's interesting changes that is worth mentioning is the new retirement savings vehicles that are going to be available for children. These are called Trump accounts. And so this is a new type of IRA that was really created to kind of jumpstart retirement savings for children. And the way that it works is that the contributions can be made before age 18 annually without earned income requirements. And so when you think of investing in a traditional IRA, investing in a Roth IRA, maybe from your perspective, for the people that are listening to this, assuming that it's not somebody under the age of 18, you've always needed earned income to back those contributions. That is not going to be the case for this Trump account. The investment options or flexibility is going to be limited, and there's kind of going to be a menu of some low-cost U.S. based stock funds. So just want to be clear on that the investment options are kind of preset for these accounts. There is talks about a pilot program, and we're actually going to be waiting for some additional language to come out on this, but a special program that's going to allow the U.S. government to provide a direct credit into the Trump account for children that are born in specific years. So again, we'll be keeping an eye out for future, additional language in that area. What's the impact here? It's pretty straightforward. This is just a new, unique way to save for a child's, long-term retirement, try to build those good habits when it comes to investing young. It's addressing some limitations of existing accounts, meaning, addressing limitations with 529 plans or the Uniform Transferred Minors accounts, UTMA accounts for short, which is a non-retirement account or a non-tax sheltered account. So it's addressing some limitations with those two accounts. It's also going to give the children the tax deferred growth. That's what an IRA does, meaning whatever happens inside that retirement account from a tax standpoint, you're not worried about. And it's going to avoid something known as kiddie tax, which really is going to apply not to the 529 plan, but to the UTMA accounts for people that are funding those for their children. The kiddie tax, we're going to cover it in the blog post, but it's just a unique tax structure for minors with investment income and how that is taxed once they cross a certain threshold. What the blog post is really going to do is help kind of give you a better understanding of in which circumstances or which situations each account is going to be more appropriate. So whether that be the 529 plan, the Trump account, or again, the non-retirement, the UTMA account, which again is just a taxable investment account set up for minors with a custodian that is overseeing that account. Nick, the final change that we wanted to cover in this episode had to do with the clean energy credits. Do you mind discussing that, please?
Absolutely. Clean energy credits in the current tax law, there are a number of tax incentives that encourage people to do clean energy things, purchase clean energy things. So electric vehicle credits are an example, energy efficient home improvements, solar panels, there's a few others, but things of that nature. These credits were set to expire at a certain date in the current law. Previous law, yeah. The law that is now current, that was just passed, has accelerated that expiration to essentially where they expire now in this tax year in 2025. So it's a use it or lose it situation. The planning implication is very simple. If you're right on the edge of getting your electric car or your solar panels or your energy efficient windows or whatever it is, just do them now so you can get the tax credit. I just had a client call at the end of last week who's been thinking about solar panels, and he was like, you know what, it's finally time to do this. I want to get the tax credit. It's like a no-brainer to do. So very straightforward on that front.
Sure. I appreciate it, Nick. We know that there's a lot here, and there's even more if you read online. Again, we were selective in the topics we covered and didn't. Blog post certainly going to provide more context than the podcast did this time around. Dates, income limitations, just things that you need to be aware of. Like I said earlier to our client, asking what are your thoughts on the law that was recently passed. Feel free to direct them to the episode or the blog post on our website in hopes that it might provide them with some additional context. Per usual, we appreciate you guys tuning in, and we hope you found it informative.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.